It's our first market update of the year. Really glad to be back with you. And it seems like we've been away from one another for a little bit. If you've been following these market updates, I don't believe we held the December one, so there's a lot to go through. We're going to see just a lot of new information here in this market update. I'm going to make it as succinct as possible. Normally, I try to hit 20 minutes on these. We'll probably be right at around 30. And the reason for that is there is a lot to get through. So number one is I just want to make sure you can hear me, that you see me. So if you can go to the chat, just let me know that I'm coming through clearly, that you can see my video and all of that. If you would go to the chat and let me know, I'd appreciate that. And we'll get rolling here in just a moment. All right, so if we're in the chat, can you hear me? Can you see me? I don't actually see those coming through. It looks like it is now. Okay, good. Thank you, Gene. I appreciate that. All right, so assuming that all the video and tech components are working well. By the way, if you're watching us on YouTube, then this is your first time to the channel, make sure you hit the subscribe button, tap the bell for notifications, and we will keep you updated on everything happening here in San Diego. And whether you're making a move in 9 days, in 9 months, in 9 years, we absolutely love it. We hold Zoom sessions, phone calls, emails, texts with people just like you every single day. So right now, the goal of the day, if you've been on these before, is we will stick to nothing but the market information. The goal is let's get what you really will not find on the news, but that is based in pure fact. In fact, bring the facts. You can do your own interpretation. And I'll show you exactly what I'm looking at to arrive at the conclusions that I am guiding my own investments in, my own real estate holdings, my family's, our clients, and here in this case, yours. So let me bring the presentation up. We'll get started and we'll bang through this as fast as possible, but we'll make sure that we cover everything really thoroughly because like I said, there is a lot, especially with the recent inflation readings that just came out and what's happening with interest rates and what we're seeing in the market. The market activity we're seeing is just completely bananas. So, all right, here we go. Let me actually back up here. Let me make sure you can actually see me. It looks like I'm teeny tiny on the screen. So one quick second here. Oh, where are we at? They changed this thing on me. There we go. A lot better. All right. So, all right, I'll come back down over here. So I run the beer hunt team at eXp Realty. This is a very brief introduction. We'll jump right into it. Sold more than $2.5 billion worth of real estate here locally, which has landed us on, everywhere from Wall Street Journal, top 50 teams in the country, Inc. 5000 4 times, San Diego Business Journal, best places to work, San Diego Business Journal, top producing team in the county, expert guest on NBC, ABC, Fox Local News, all that just to say, I've been around for a long time, been around through different markets, been around through recessions, including the Great Recession. So I want to give you context as I give you advice. This is me behind the scenes or behind the billboard, so to speak. So these are recent pictures, very recent pictures from New Year's where we went to a really fancy restaurant. It was absolutely terrible. So we ended up ordering Papa John's in the rain and eating in a car to a little ski trip there with my daughter on her very first ski lift and just a lot of fun. My son's first football game. We went over to SoFi Stadium and then I'll jump over here. There you can see my wife and I, and the little trip we took to Aspen was really, really great. So, all right, let's jump over to the information. Here's the agenda today. Number one is we're going to cover where mortgage rates are at, where inflation is. We'll also do a total market overview, of course. CPI report, huge in terms of the impact that it's having, but I'm going to make some pretty bold predictions as far as what is happening and what we see happening with not just market activity, but with interest rates specifically, which are driving that. And I'll show you the proof of where I'm deriving it from so you can draw your own conclusions. Interest rate predictions, we'll go ahead and make those. And here we go. So number one is, let's just grab a quick look at the market statistics, the same statistics, that we cover every single month over here. And let's go through and I'll tell you what we're seeing. So number one is new listings. New listings, and before I even jump in too much further, I should mention if you have any questions, get them into the chat. I always answer every single question in the chat, and then I answer every email I receive afterwards. So just make sure you put any questions about what I'm talking about here, and I'll answer it. So new listings, down. Okay, so based on December of 2021, December of 2022, which is the reading we have, right? We haven't finished yet this January. down 41%, meaning 41% less new listings hitting the market. And so when you have that much fewer new listings hitting the market, which I want you to notice, if you skip over to the right in this section, it says year to date. Well, year to date only down 14% versus where it was a year ago. So that's kind of interesting, meaning the January gap, or excuse me, the December year-to-date gap, not quite as dramatic. It's starting to narrow. We're seeing a little bit more activity, more inventory. Back over here on the left side, though, pending sales down 32%. Okay, so 41% less new listings, 32% less pending sales, closed sales 48.9% fewer. So that tells us we're having an absorption rate issue in December. Now I'll tell you what we're seeing on the ground here in January, which won't hit the statistics till next month, but because we're in it, in the trenches every single day, I'll share with you the massive changes that we've seen so far. But median sales price really staying flat to what it was a year ago. Okay, average sales price up 1.5% versus what it was a year ago. So why is that happening with the high interest rates, but also with the why is that happening with the high interest rates, but pricing is staying pretty flat, if not even rising a tad bit? And the reason for that is simply found in the fact that we have so few new listings. So there's new low inventory that's going to keep driving the picture for a long time, because that's the principle of just supply demand is in play. I want to jump down here to days on market, up 72%. So homes are sitting on the market longer. And that is just something you have to be aware of, that from a listing side, if you're selling your home, that's just a fact. So make sure you're competitive. Make sure that you list your home ahead of the marketplace so that you're not having to chase the market. That's a concept that we reviewed last time we were together, and it's really key. That's what people are doing right now that are having success. And I want to jump down here to homes for sale, 53% more inventory, 100% more inventory. So it's doubled, but it's still dramatically low. 1.2 months of inventory where it was 0.6. Well, historically, even 1.2 would be dramatically low. It's not until we get to like 3 to 4 months that it starts to feel a little bit level, and it'll feel level all the way through about 6 months. Real buyer's market, once we get into the 6+ month range, that will definitely feel like a buyer's market. So that's just a quick look at the current market statistics. But what I'm excited to share with you is all about what is happening with mortgage rates, all about what is happening with inflation, and how the relationship between those two is something that I want to basically teach you how to watch, how to read, so that you're able to make your own conclusions well ahead of where your either competitive buyers, owners, tenants, landlords, investors it will be, because they're going to be waiting to read the news while you're ahead of it. So number one, I want to take you through this. We'll spend a little time on this slide, but this is key. Okay. It's really important to understand that on a 30-year fixed rate mortgage, on an $875,000 home purchase with 20% down, and that math actually, by the way, is, yep, that's correct. So it would be a $700,000 loan. That payment, okay, on that $700,000 loan, just a short time ago when interest rates were at 7%, would have been $4,657 a month. Today, rates have dropped. So we are well off our highs. Okay, when we were getting 7% rates, and a lot of buyers were saying, hey, I'm waiting for rates to drop. And now we're going to start seeing why the market activity has picked up so much. Well, people were waiting for rates to drop, and guess what? They've dropped down to 5.875 on that same loan that would have cost you 7% just a couple months ago. And mortgage payments on that same loan now $4,141. Okay, so much lower, saving you over $500 a month. Now, that's the good news of it. The bad news is that they were once 3%, and at 3%, the payment would have been $2,951. So that tells us that payments today are $1,190 higher than they were about a year ago on the same size mortgage. Okay, but there's more to the story, and people normally stop there. So when we look at affordability, it's mitigated by salaries. Salaries across the nation are up 7.6%. So when you look at a household earning, say, $100,000 a year, and they have a salary bump of 7.6%, which is $7,600 over the course of the year, divide that into two, Well, let me bump this little, my head. Let me bump that up here so you can see this. Okay. They now earn $7,600 more, which means $633 more per month. So the $1,190 higher payment, they actually have $633 more in income. So that is largely mitigated. It's really about a $500 gap in affordability. And that is really important. So now affordability is still down. And if you saw the market update, the previous slide, you saw affordability is down, but it is not nearly down as much as the news would have you think it is, because they're not going to give you this final stat on how salaries are up and therefore mitigating that gap. And when we look at where interest rates are going, what activity is doing, there's a lot to that. And by the way, before I even move on, let's acknowledge that had you gotten that 3% rate, call it in March of last year, well, you could probably buy that same house today for less money. Okay, so that same house is not going to have, 15 offers on it, and you have to go way, way, way above the asking price. So you're probably buying the house for less money, and so that even crunches down the affordability gap even further. And we're now starting to see that pick up, where buyers are going to win. Right now, their average borrower right now is in a sweet spot. And here's what I mean by that. When rates were at 3%, okay, and there was just stupid activity in the marketplace, like crazy activity. Well, when rates were at 3%, and if you were not a borrower that had 30, 40, 50% down, if you were not a cash buyer, if you were not just supremely qualified over the top, you were well qualified, by the way, but you didn't have 30, 40, 50% down, you were getting beat. And so at 3%, it was very, very hard for the average buyer to get in. Now, interestingly enough, you go to 7%, and it's not an option for the average buyer to get in. They get priced out. But here, as we sit in this 5.8% range, all of a sudden, we're in a buying sweet spot for most people because affordability gap has very much come down. You're enjoying the fruits of those raises that happened. And at the same time, you don't have that like furious, just crazy activity that makes it impossible to get in. So you're in one of the only, and by the way, this is a quote from the housing treasury, from the housing secretary, just a few days ago, saying, I pull it up here. You know what? Why don't I just do that? That's the beauty of being live with you. I want to read it verbatim, and it'll take me 10 seconds to bring it up. There it is. It said, be advised. This is the Treasury Secretary, or excuse me, the Housing Secretary. Be advised, this may be the one and only window for the next few years to get into a buyer's market. And remember, as the Federal Reserve data shows, home prices only go up and always recover from recessions, no matter how mild or severe. So this is just this period of time when most sellers are still under the impression that it's a tough time, that rates are down, and you as a buyer can get in. And of course, you always have the refinance option because it's the whole, date the rate, marry the house, date the rate, right? In that, if you secure the right house, you don't get beat out by all these people. You're not priced out by rates where you don't even have the option to buy. And then if the rates drop, guess what you do? And we do think the rates will drop. I'll show you in a moment here why. All right. Well, the story on why is all tied to inflation. Okay, so let's take a quick look at inflation. And this is really key. By the way, a lot of what I'm going to show you here comes from MBS Highway and Barry Habib, who we follow religiously on understanding the mortgage markets. And my job today is to just let that flow through me to you and just distill it down to where we all understand exactly what's going to happen. So these are the monthly readings of inflation of each month: December, January, February, March, right? The months in yellow, they've already fallen off. So this was, by the way, through November. Now we already know what the December reading was. It was 0.3, which validates the very reason why we believe they are going to keep dropping. So if you look at December of 2021, the reading was 0.6. Okay, 0.6 was the amount of inflation that month. And so what happens is if you come forward and you read October, November, 0.3, 0.2, we're getting lower readings. Well, When we get the new December reading, the old December reading falls off. And if the new December reading is 0.3 or 0.2 and you lose a 0.6, guess what happens? You have a drop in CPI, the reported inflation number that everybody is watching, the markets are watching, and that are very much getting tied to where interest rates are going. And in fact, that's exactly what happened. You go to December and there was a 0.3% reading. So we replaced a 0.6 from the previous December with a 0.3 from the new December, having it drop. And in fact, the CPI reading, which was predicted to be at 6.6, actually came in at 6.5. And I've got it here in an upcoming slide. Let me see if it's this next one. It's not, but it is well down from where it was on the previous reading. So we just keep seeing this drop. And if you look at what's happening in January, there's a 0.6 that will drop off. In February, a 0.5. What if those are also replaced with a 0.3, with a 0.2, with a 0.4, even a 0.4 would reduce it. Certainly a 0.2 or a 0.3. Now, not so much in March, but as you look at April, May, June, those are big numbers that are going to chop off and could very easily be replaced by lower numbers. And as that happens, Wall Street celebrates it, the bond markets respond, the mortgage markets respond, and interest rates on mortgage loans drop. And so that's the very reason that we are now, by the way, as October replaced the previous October, as November replaced the previous November with higher numbers, right? These lower numbers replaced the bigger numbers. That's why we're no longer at the 7% rate. That's why we're now at 5.8 or so on a just typical 30-year mortgage. So really important to understand that. If you have questions around that, you must send in either an email with a question or just put it right here in the chat. I'll be sure to answer it. Let's go here to the next one. What do we think the Fed will do given these inflation readings? Well, Wall Street, we always like to give you these. Currently, the target rate is at 425 to 450 basis points, right? Or 4.25, 4.5. That's where the Fed funds rate is sitting. The Fed funds rate, of course, is that rate that the Federal Reserve lends to banks, who then lend to us. So the next meeting is taking place on the 1st of February. And Wall Street has a 94% bet. Okay, Wall Street money, 94% of it is betting that there's going to be a 1/4 point raise. And the way you understand that is you see the 425 to 450 here at the top. Well, if you go to the bottom of this little graph, you see 450 to 475. So that's 25 basis points higher. Wall Street is betting that the 3/4 rate hikes are way long gone. And now that even the half rate hikes are long gone, now we're going to go with a 1/4 point. You go to the next meeting, which is the March meeting, they are predicting also a 1/4 point rate hike. So that would be 50 basis points beyond where we are now, right? After 2 1/4 point hikes. You go to the following meeting and you'll notice that they're predicting they will stay put at 475. So they think that we are just 2 meetings away from hitting our ceiling and the Fed not raising rates any further. And so what will determine that, though, this is why you have to understand the inflation side. As the inflation readings come out, if we have an unpleasant surprise where inflation comes in higher than we thought, you'll see these charts completely shift immediately where Wall Street will say, whoa, maybe there's going to be a 1/2 point hike. We think interest rates might go higher. You'll see that trickle down through all of the capital markets. Now, shelter costs. Shelter costs, think of this basically as like apartments, okay? What it costs to just shelter. So shelter costs, the key thing to understand about this and the CPI reading, I wanted to bring this forward to you. And I debated if I wanted to get this technical, but I think it's important to understand that 39% of the CPI reading is shelter costs. So when you look at the pink line, apartment listings, okay, the rent year-over-year change on apartment listings, well, you'll see that it held pretty flat, though, with a little bit of a rise here in 2019. All of a sudden, the news starts getting kind of funky. There's this thing going on in China. There's a little bit of a dip, and then holy smokes, it's, COVID's here. Boom. All of a sudden, those list price drop on rents because landlords didn't know if they could even do business anymore, right? There was a lot of uncertainty, but as soon as the market turned out the way it did, well, those rents shot up. They shot up in a big way. And what happens is there's a lagging relationship between CPI which is inflation reading, and those apartment listing rent rates, which are 39% of the reading. So you'll see that it shot way up and the CPI readings finally, after some lag, finally started to rise. Now it's really important that as you see the apartment reading drop, this is still an increase, okay? This is year over year change, meaning it's decelerating in how much rents are rising, but rents are still rising 4.6%. Having said that, it is decelerating. And so what you'll see is that that blue line, after more rise, because there's a lag, it will eventually follow and drop, which means that this is a long way of saying that these decelerating rent prices will contribute to lower inflation readings, which will contribute to lower mortgage rates. Okay. CPI in November of 2022 was at 7.1%. In December, it was predicted to be at 6.6%. Okay, we just got the December reading. In February, we'll get the January reading. So in November, it was at 7.1. December was predicted to be at 6.6, came in at 6.5. So that is the direction of where inflation is headed, which is exactly what is influencing what's going on with mortgage rates. This is a really interesting graph also from MBS Highway and Barry Habib, I found this tremendously interesting. I wanted to bring this to you. So people often also focus on the 10-year Treasury note, okay, the 10-year Treasury and how that rate, what the relationship is between that rate. Here I am on your lower left, not to pop around, but I don't want to block the views here. So you'll see that the blue line is the 10-year Treasury yield, meaning the coupon rate or the amount of interest it pays when you buy a 10-year Treasury note. The yellow line is 30-year fixed rate mortgages. And you'll see how closely they've always followed one another. Now, the place where people are wrong, and I kind of like to just point it out, is people think that it's the 30-year mortgage is determined by the 10-year. Well, not really, because it's actually inflation that is influencing both. So, and the 10-year tends to follow that 30-year, the 10-year tends to follow inflation. Mortgage rates are following along as well. But anyway, you'll see these red lines, and what it's showing you is that the gap between where the 10-year Treasury yield is and 30-year fixed rate mortgages, normal spreads about 200 basis points. Meaning if the 10-year Treasury is paying 2%, well, mortgage rates tend to be 4%. If they're paying 3.5%, then 30-year mortgages tend to be at around 5.5%, so on and so on. And you'll just see that relationship is always pretty much held true, where there's that normal spread is about 200 basis points or just said differently, 2%. Fast forward to where we've been very, very recently, and the spread widened a big deal, okay? It widened all the way to 300 basis points. So in other words, rates were at about 7%, but the 10-year Treasury rate was at about 4%. So while the 10-year was paying 4, mortgage rates were at 7, that 300-point gap, now we've already seen it start to narrow. And as that narrows, right now it's about a 250-point gap between the two. But it's just really an important thing to note that we are in a larger spread environment than normal. And so as Treasury rates, which as of today, they've actually dropped as, today when the day that I'm filming this, went down to right about the 3.3 range. And so if they reach about the 3% level, which is what the experts I follow think is going to happen, then that tells you that mortgage rates would probably hit about 5%. Okay, so we'll revisit the mortgage rate forecast in a little bit, but that's going to be the answer. We think that they will hit about 5% in the first half of this year. Recession. Recession is something that influences interest rates and it pushes them down. In fact, if you go back to before the Great Recession, interest rates were about 6-7%, right in the 6% range actually, before the Great Recession actually took hold. And then of course they dropped because the Federal Reserve tried to stimulate the economy. So this is interesting to watch and a little bit scary as an economy is concerned, because you'll see that credit card rate usage was just, that revolving debt was growing in a big, big way. And then that thing you see right there, well, that's COVID-19, and that's the recession that, the very brief recession that we experienced. But what happens if you look at the bottom is that in January of 2020, savings were at an all-time high. they started to drop. Everything started to get a little bit funky. But what you see with those spikes in that personal savings rate, well, that's actually the federal stimulus that came through. So the spike in savings was actually stimulus money. And if you look back at the credit card money, once people kind of figured out like, oh, whoa, I just got all this stimulus from the government, I just got all this free money. Well, what happened is they started to increase their lifestyle. And you see credit card usage just skyrocketing. But what happened is savings never recovered because people bought into a lifestyle that was afforded to them by stimulus, which was, of course, ephemeral. It was temporary. So that is a picture that will break, period. It will break. We will be in recession officially, though most of us think we already are. And of course, we never get to find out if we are until well after we already were, once they get us the readings. But this picture tells you that there is, that's a train that ends up crashing, okay? So we're going to hit recession. And what happens, why is that significant? Well, if you go ahead and look at this, you'll see that this is the inverted yield curve, okay? And I know I'm throwing a lot at you, but this is really important. Again, if you have questions, put them in the chat, put them in the comments if you're watching on YouTube, or send an email to dan@beerhometeam.com. And the reason for it is what the inverted yield curve is, just as a principle, okay? 10-year treasury notes, T-bills, should be paying a higher interest rate than a 3-month, than a short-term bill. If you're only committing your money for a very short period of time, they should pay you less money. And if you are committing your money for a longer period of time, they should be able to pay you more. And so what you see is that the difference, if you do the 10-year yield minus the 3-month yield, the 10-year yield minus the 3-month yield, you always have a positive number, almost always, and that's the key. But you'll see that that positive number is typically in that, kind of hits that 3% range and then tends to dip down a little bit, but certainly 2% seems to be right in the middle of that. So there's typically about 2 percentage points more being paid on the 30-year than on the 3-month. On the 10-year than on the 3-month. Except for these little times when something called the inverted yield curve happens, and that's when the 3-month actually starts paying more than the 10-year. And in these kind of vertical bars, okay, those white vertical bars, that shows you when those are the recessions that follow that. So if you look at the zero line, you see that the inverted yield curve, right? When you do 10-year minus the 3-month, it goes negative, and what follows is recession, that vertical white line. Then you go over to the 2000, early 2000s right there. They dipped down. That was right around 9/11, of course, and following the dot-com bust, and recession follows. The next time that they dipped down in that same range, it ended up being the Great Recession. But the yield curve inverts. The 3-month is paying more than the 10, and what followed was recession. And you go back to 2020. This is COVID, and the same thing happens. It dips down below zero, and recession. And now look where we are, well below zero. The 3-month is paying significantly more than the 10-year. So it's first times for everything. But I'm going to go with history. Recessions is in front of us. Why does that matter in the conversation that we're having? Well, for 2 reasons. One is recessions tend to push down rates. Number 2 is real estate actually very much outperforms in recessions, the grand majority of them. In fact, the only recession where real estate did not outperform on this chart is the 2008 recession, but that's because real estate caused that recession. The other ones, real estate was actually the outperforming asset class. And so that's really important to note. People will tend to flock to assets, right? Real assets, hard assets. So that is the picture that we're seeing. And this just illustrates, first of all, why we believe very much that we're either in recession or we're about to be, and also why there will be further downward rate pressure, which is good for the real estate market. Now, housing demand and formations. This was really interesting. This is something I recently learned, but I found it fascinating. I wanted to share it with you. And so if you look right about 1.7 million new households, that's about what we get. Okay, 1.7 million new households are created every year, whether that's a 20-year-old something that finally leaves the house, whether it's, it could be a family that was together who unfortunately splits, and now there's a new household. So Household formations, we get about 1.7 million new household formations a year, which creates demand in the marketplace. But currently we're sitting at 1.3 million. Why would that be? Well, it's because interest rates have been so high. So how many people do you know that have been, when rates were 7%, were waiting for them to come down? Well, that tells you that there's probably a lot of people that are hiding out in mom and dad's, waiting for those rates to drop so that they could finally go and be a first-time buyer. And so that creates that that sucks demand out of the marketplace. And if we look at this next slide, you'll see very well illustrated that housing starts completed, 1.5 million housing starts were completed. Okay, are completed traditionally. This is the average, like about 1.5 million new households are created, but about 100,000 of them, 0.1 million, 100,000 of them have to be replaced every year because they just go obsolete, right? They're just that old, that decrepit. About 100,000 of them just go out of service. They have to be demolished. It turns back into land, which gives us a net new supply every year of about 1.4 million new housing units. Housing formations, which we just covered back here, okay, currently at that 1.3 million level, where traditionally it's at 1.7. So if we get 1.4 million new housing units and there's 1.3 million new household formations, then that tells us that we have more than enough supply, pretty balanced, not crazy supply, but we have enough to accommodate the 1.3. But what happens when we go back to 1.7? And what makes us go back to 1.7 is lower rates, more affordability. And what gets us lower rates is lower inflation. And what gets us lower inflation is those old months of CPI readings dropping off and the decelerating rent prices, which make up 39%. So you see how the whole picture is coming together. And now you get these additional housing households that start to form. You go back to the 1.7 million and it is too much. It's too much. The 1.4 million new housing units supplied every year puts us back in a deficit, and of course creates activity, creates upward pricing pressure. So it's a really just interesting way of looking at real numbers and what the relationship is to one another, so you can draw a conclusion on what is happening. Home price moderation. This was just another kind of interesting slide. I'll scoot my stuff over here now so that you can see it. So here, let's go lower right. So over the last 10 years, housing prices across the country up 115%. Over the last 2 years, up 39%. Very recently here, down 2.5. So yes, there has been downward pressure as a nation. I showed you the local numbers here. Locally, we're actually pretty much just flat, but people are calling it a housing crash, and it's hardly that. Now, could it be? Sure. We don't know what will come, but if you believe in history, if you believe in just the relationship between these numbers that I'm sharing with you, there's a lot of reason to believe that we're going to see increased activity in the housing market, that interest rates will be lower, and that in fact activity and pricing will stabilize and rise. And I can report from the trenches here, just tell you that over the course of the last 10 days or so, we've had, height of 2021 level activity. I mean, it's been active, like really active. And a lot of what we're talking about hasn't even fully kicked in. Still believe that rates will drop further, closer to 5%. That's just a prediction. So we'll see where that goes. But it's just interesting. Now, does a week create an entire trend? Of course not. But I can just report to you that that was a common thread in my network across the country, everyone reporting the same thing. And when I mean everyone, I don't mean everyone because I don't talk to everyone, but everyone at the top of their particular markets. We all talk, we all get together, we all mastermind. And it was a common thread. So something to know. So here's the forecast. We'll see low single-digit appreciation for most of the United States with a lot of increased activity. The reasons for that would be lower inflation, recession-like slowdown, which pushes rates down further, incomes increasing to help affordability, very tight inventory, rents are still expensive and rising, and rates move near 5% during the first half of 2023. That is the prediction. Which will get us to that relationship again between the 10-year Treasury note and interest rates, should that 10-year Treasury hit about that 3% range, which should happen if the CPI readings go the way we think they will. And so that is the forecast. I do want to thank Barry Habib, MBS Highway, for educating me, and I am educating, paying it forward, right? Just letting it flow through me to you. But that's who we follow for a lot of our mortgage market information. On this forecast, or excuse me, not forecast, but on this update that I like to give once a month. We cover a whole lot of things, including how sellers are behaving, buyers are behaving, things more from my field. But today I thought this was really, really relevant because, well, when I learned it, I said, yeah, that makes a ton of sense. And so that's going to help me form my conclusions. And of course, you should form your own. I do answer every single question that comes through. So if you want any questions personally that you want me to answer myself, I'm at dan@beerhometeam.com. That's right there on your screen. And with that, I hope that you have an amazing year. Keep your head, just watch for what's happening. Listen for the language being used during the Fed meetings. If you see on CNBC or Bloomberg or whatever you follow for financial news and you're reading and you're hearing about the inflation reports, now you know what to look for. And I'll see you on the next edition of our San Diego Market Update. Thanks. Have a great one.